My name is Suraj Karia, and today I'll be using the HOLT Lens tool to explain why I think you should buy Burberry shares as opposed to LVMH shares. My proposal is targeted towards the risk-neutral investor.
Burberry is a British luxury fashion brand operating across three product segments, with fashion accounting for the majority of revenues, unlike LVMH, which operates in more product segments. Burberry generates 38% of its revenue from the APAC region, demonstrating its reliance on demand from Chinese consumers, 8% more than the industry average and 3% more than LVMH. The HOLT relative wealth chart shows us that, unlike LVMH, Burberry has experienced heavily fluctuating CFROI and asset growth rates, with 2007 to 2012 seeing a steep rise in these, resulting in shareholder value more than doubling due to Chinese economic expansion. Despite increased asset growth rates between 2012 and 2015, CFROI levels declined as increased investment in the APAC region saw declining returns. This volatility means that Burberry is more inclined to fade than LVMH, but is also more likely to experience rapid growth. The last year has seen Burberry's share price decline by 35% compared to LVMH's decline of 9% due to declining demand from China and uncertainty regarding management. Burberry looks to be in the mature stage of the corporate life cycle. However, I believe due to Burberry's unique position in the market, they are primed to enter a new cycle. Using HOLT's Flex Valuation tool, I forecast increased sales growth, EBITDA margins, and asset turns. With the launch of the new range of rucksacks, which sales soared in the last quarter of 2015, and the relaunch of signature Burberry products, demand for China is set to increase. Moreover, Burberry has established itself as a market leader in digital e-commerce within the luxury goods market, ranked second in the Digital IQ Index in China. This is a significant factor in Burberry's growth, as 83% of the growth in luxury spending in 2014 was attributable to online sales, compared to 33% in the previous year. Burberry has also embarked on a £100 million cost-cutting program, which should improve margins and asset turns. Should Burberry capitalise on these competitive advantage, I believe the sales growth rate will increase to 4% in 2016 and by 1% a year thereafter, and CFROI would rise accordingly to 14% in 2021. This results in a warranted share price of £14, 28% above the current market price. However, I recommend this stock for risk-neutral investors due to its dependence on increased Chinese demand and European stability. LVMH is the world's largest luxury good provider, operating in more segments than Burberry, such as selective retailing and luxury wine and spirits. LVMH has less exposure to APAC and generates 60% of its revenues from Europe and the US. Over the past decade, CFROI levels remain constant above the cost of capital, between 12 and 14%, enabling LVMH to grow its assets. LVMH's strategy of continual expansion in each product segment has led to incremental rise in shareholder value over the past decade. However, given LVMH's lack of exposure in digital e-commerce, lack of focus on the APAC region relative to Burberry, and strategy to keep expanding all product segments incrementally as opposed to focusing on any radical innovation, I believe sales growth rates will decline in the same way as in previous trends, leading to a slow fade in CFROI rates. As a result, I agree with HOLT's valuation of LVMH that it is overvalued by 2%, hence I recommend purchasing Burberry shares as a high growth stock. Thank you for listening.